Okay, so we've just completed our May 10th transaction. Time to move on to the next one. May 11th, the company bought a new computer diagnostic tool which cost $10,000. The company bought the asset on account. Okay, there's that magic word again. We bought something on account. That means we bought something, but we didn't pay for it. So the question, is cash involved? Well, no. If I bought something and I didn't pay for it, then there's no cash. But let's work through it. The company bought a new computer diagnostic tool. So we got a new computer tool. That's an asset. That's something we own and control. It's good for our company. I'm going to assume it's a long-term asset. So it's an asset. It's going up. We're going to debit that asset. So let's debit this computer diagnostic tool. I'm just going to call it a computer tool. And we're going to debit it for the amount we paid, $10,000. Well, the amount we didn't pay, but the amount it's worth, $10,000. Now, normally, again, we buy something, we credit cash if we pay cash. In this case, we bought the asset on account. That account payable is coming up again here. We have a liability. We owe these guys money. We owe them $10,000. It's a liability going up. I didn't owe them anything on May 10th. I owe them 10 grand on May 11th. That liability is increasing. So I'm going to credit my favorite credit, accounts payable. I credit that for $10,000. I'm going to put a date on this. And again, my description would be purchased a computer diagnostic tool on account. I mean, pretty straightforward. Okay, let's move on. May 14th, the company earned revenue of $7,500. The money was not yet received. So, in answer to the question I'm always asking, did money change hands? The answer is no. There's no cash involved here. Well, I can deal with the first part of this pretty easily. We earned revenue. Revenues always take a credit, so we're going to credit revenue. And we established that Gurjeet's computer does repair, so we're going to credit repair revenue for $7,500. I've left room for a debit. So if I do a bunch of work and I don't get paid, but I'm owed money, that situation is called an account receivable. It's kind of the opposite of a payable. Somebody came to us, we did a bunch of work for them, and they said, hey, send me the bill. They owe us money. That's an asset called an account receivable. It's a current asset. So we're going to debit A/R for accounts receivable, and the amount of that receivable is $7,500. The date here is May the 14th, and the description again is earn $7,500 on account, or earn $7,500, didn't receive the money, something like that. Let's carry on. May 21st, the company paid salaries of $6,000. Is cash involved here? Yes. Right? Always ask yourself that question because it makes the journal entry easy. Is cash involved? Yes. Is cash going up? No, cash is going down. Cash is an asset. We got an asset going down. Let's credit cash. Again, I'll leave room for the debit. Credit cash, $6,000. Our debit here is, well, what do you think salaries are to a company? Are they an asset? No way. A liability? Well, we can owe salaries, but that's not what this is. Shareholders' equity? Nope. Revenue, expense, or dividend? Salaries are an expense of a company. They're a cost of doing business. If you want to have a company that has employees, you've got to pay their wages. Wages and salaries are expenses. So we're going to debit salaries expense for $6,000. Our date is May the 21st. Just a quick comment here. A lot of people get expenses and liabilities mixed together, and they do often go hand in hand. And as you practice more journal entries, you'll get a feel for when we're paying off a liability and when we're paying an expense. In this case, we're considering salaries to be an expense. Let's move on to the next. May the 24th, paid cash of $128,000 to acquire a building. Oh, okay, so I remember a few journal entries ago we borrowed a bunch of money. We said we're going to buy a building with it. Well, now we've bought that building. So we bought a building for cash. Was cash involved? Yes. What's cash doing? Going up or down? Well, we paid cash, so it's going down. It's an asset. Cash is like the main asset. It's going down. Let's credit cash for $128,000. That's quite a bit of dough. Debit, well, what did we buy? We bought a building. A building is an asset. It's an asset that's going up now. We have more buildings today than we had yesterday. Let's debit building for $128,000. Barely have room to date this. It's May the 24th. And again, the description would be purchased a building for cash. Let's carry on. May the 25th. The company paid for the equipment it purchased on May 3rd. I'm going to scroll all the way up in this problem and find May 3rd. Oh, there it was. May 3rd, we bought $2,000 of equipment on account. So we said, give us the equipment, we'll pay you later. Well, now in the entry we're looking at, we're paying them. So how much are we paying them? $2,000. Is cash involved? Yes, cash is going down. So when we pay off this bill, we're going to credit our cash because cash is going down by $2,000. So let's go down there and credit our cash. Let's see. There we are. So I'm going to credit cash because I paid my debt of $2,000. Now the debit here is a little bit tricky, and students often get this one confused or they get it wrong. What we're got to say here is we didn't buy any more equipment. I'm not going to debit equipment. I've already got $2,000 worth of equipment on the books. Look back at your May 3rd entry. We already debited equipment, so I don't want to do that twice. We paid off our equipment purchase. What we did was we paid off our debt here. We said we owe these guys $2,000. We don't owe them $2,000 anymore. Our liability needs to go down. The amount we owe them, remember, liability is what we owe. The amount we owe them just went down by $2,000. So I've got to reduce my liability by $2,000. Our liability, again, maybe flipping back to May 3rd, our liability was called accounts payable. We said we owe them $2,000 in accounts payable. I'm going to make that liability go down. By debiting it, I'm going to debit my accounts payable to reduce the amount I owe them. Debit accounts payable, $2,000, and the date here is May 3rd. Again, my description would be paid off the equipment purchase of May 3rd. Just saying what it says here in different words. Okay, let's move on to the next one. May 26th. The company received the service revenue that it earned on May 14th. Okay, there's another one that's referencing something. The company received the service revenue that it earned on May 14th. Let's go up to May 14th. May 14th, there it is. Oh, right, we did revenue of $7,500, but we didn't get the money. So now it's saying, hey, we got the money. All right, so how much money did we get? We got $7,500. Our cash is going up by the $7,500 we received, so let's debit cash for $7,500. So again, we received that money that we had already recorded as being earned. I'm going to debit cash to say I got the money, $7,500. Oh, I want to erase that little bit. I'll just put an X there. $7,500. Okay, so we got cash of $7,500. But what's the other piece of this puzzle? What's the credit here? Well, let's look back to that transaction. So the company earned revenue of $7,500. It wasn't receiving. We had debit AR, $7,500. Credit repair revenue, $7,500. So I'm certainly not going to credit repair revenue again. That would be double counting. That would be recording repair revenue twice. What I need to say is when I set it up here on May 14th is I said, you owe me. That's what account receivable means. We said, you owe me $7,500. Well, we've got to answer the question, do they still owe us $7,500? The answer is no. So now we've got to say, hey, you don't owe me $7,500. We've got to reduce the account receivable. We said the account receivable was an asset. When we set it up, we debited it. Well, now we're getting rid of it. I'm going to credit my account receivable. So let's go down here. We went debit cash, $7,500. We're going to credit accounts receivable, $7,500. Sorry about the X there. The date here is May 26th. So we said, you gave us $7,500, debit cash $7,500. You don't owe us any more money. Credit $7,500, accounts receivable. My description would be receive payment on May 14th transaction, something like that. Okay, let's carry on. May 28th, the company spent $3,000 on advertising. Okay, so first, is cash involved? The answer is yes. Cash is an asset. It's going down here. Let's credit cash for $3,000. Our debit is to say, well, what is advertising, right? The company spent $3,000 on advertising. Advertising is a cost of doing business. It's an expense of this company. Let's debit advertising expense for $3,000. More advanced students might say, well, it could be prepaid, stuff like that, and it could be, but in sort of beginning accounting, we don't. I'm not going to worry about the prepaid element that this could incur or could entail. So it's May 28th. We had a cost of doing business, that's advertising, debit advertising expense, credit cash for $3,000. There's our May 28th entry. Oh, look at that. We're at the end of the question. We've recorded all of our journal entries here. It's been quite a lot of them. But as I said, to learn this stuff, you've really got to be doing it on your own. If your instructor has given you a handout or a worksheet, you should work through it and try not to have the solution with you. Try to work through it on your own. Work through your textbook problems on your own, and I may even post a couple extra problems on here that you could work through on your own. This stuff is best learned not by copying off of me or following off of your instructor. It's learned by doing it on your own. So that's it for this video on journal entries. I hope you've got the basics of journal entries. In our next series of videos, we're going to talk about adjusting journal entries. They're more complex, they're trickier, they're more challenging, but I think they'll be good ones, and I think the videos will be useful to you. Alright, that's it for today.